It's just all local relationships. I mean, we've been in this space for a long time. We built two businesses from scratch on the advisory and financing side, and I think through that you meet a lot of people and you figure out which people are credible and can deliver things and which people probably can't. And I think it always I think starts with relationships and management. It's very hard to back an asset, I think, unless you just find something unbelievably good. I mean, you always back the team in place. So if you don't have a CEO and a guy who can really run things from day one, I think it's always going to be a struggle. So it's really about the team. And if you bring a couple of good people into the team, where you have somebody who deals with the local relationship side, you have somebody who deals with the operating side, then those types of people have the ability to pull things together in a very effective way. And I think that the investor's job is just to find those people and try to make the whole thing work. And then things fall into place. But it really is all about management in this business. Unfortunately, in mining, what you have is a lot of over-promoted geologists, calling themselves CEOs, and they don't really have a very good concept of how to use capital efficiently. Why should we spend money on this or that? So when you find people that are competent and understand what they're doing, that's very precious.
How do you structure a typical deal? How do you incentivize management?
Look, I mean, the way that we do it, I think, I think when we do things with management, they have a chance to earn meaningfully more than they would probably working with many other groups. If everything goes well, management will wind up owning anywhere between 10 and 30% of the company. So I think with that kind of incentive structure, it really brings people's best impulses forward. And from our perspective, if you can make an asset work, then everyone is much better off. So kind of I think we've seen kind of which schemes work, which schemes don't work, and I think you want people that have succeeded before, maybe didn't always get compensated fairly. And I think when we work with them, we usually try to start from day one at inception, and that's something that so far has proven to be effective. But so they have plenty of skin in the game, and if everything works out, they can walk away wealthy men.
What kind of project size is typical, and how do you guys decide whom to bring on as additional partners or investors?
I think project size, it's tough to say, because I mean, I think every deal is different. I mean, the key for us is always managing the basis. Kind of investing in mining, it's a very volatile endeavor. Things go up, things go down. So you always look for the margin of safety, I guess, paraphrasing the more value investing type of approach. So if you see something, for instance, in an iron project that we've just invested in, we were able to get the concession for a minimal amount of money, and it was right on the infrastructure. And which in iron mining is the whole game, because there's more than enough iron in the world, but there's not nearly enough iron that can get to market quickly. So over there, we saw the initial outlay it was really nothing. We did some work on it. The work came back positive, and we went forward. It was just one of those no-brainer things where you said, well, we'll spend a couple $1 million all in, and then we probably will have an asset worth, just what we think is there, a couple 100 million tons, and the infrastructure should be worth at least $40-50 million. And that's sort of, from the perspective of a steel company or a trading house, or anybody else who may want to be the final owner of that type of asset, it makes a lot of sense, because you've taken a lot of the risk out of it for them, because you've solved the infrastructure question and you've shown that you have a deposit. So something like that makes a lot of sense for us. There's gold projects where we start off earlier, but that's where our geologists have a very strong view on prospectivity, and that's sort of where we really have to go with their gut feel. But if you have a good geologist and you feel like you've sized your risk properly, then that makes a lot of sense too. So it really just comes down to risk and reward. I mean, we ourselves on the investment team are probably more comfortable in the bulks because that's a lot of where the background is. But on the precious metal side, we're also quite active because we feel like we have a lot of expertise and intelligence within the team to make very good evaluations. And at the end of the day, no matter what you're investing in, it's always about managing your risk. So we feel like we can do that very effectively in precious metals as well. And size-wise, we typically will come out of our pocket will be anywhere $5 to $15 million over a couple stages. But again, we see ourselves as more getting everything up and running. And if you do it right, then there's more than enough capital to follow behind that to move things along.